Remember from yesterday? Anything? So we're looking at theory and we're looking at reporting entities. And what did we say about reporting entities yesterday? Okay, basically reporting entities are basically if you are a reporting entity, you have to provide general purpose financial statements in accordance with accounting standards, and you have to have those financial statements audited. Okay, so what is a reporting entity? A reporting entity is an entity that has resource providers who are dependent or cannot obtain financial statements or information on their own. Okay, so I gave you the example of myself. If I'm a shareholder of BHP Billiton, I only have 0.001% of the shares. Okay, if I go to BHP Billiton and say I want information about your assets, they're just going to laugh at me because basically, if I sell my shares, it's not going to make any difference to them. Okay. So a reporting entity generally is a company or a business where there is separation between management and owners. Okay, what do I mean by that? Just remember that when companies first start out, management are generally the owners. Owners are generally management. So if you start out a business, you are going to put your own money into the business, or you're going to get a loan from the bank, and you're actually going to manage the business with a couple of friends maybe. Okay, so you are the manager and the owner. So when a business generally starts out, it's quite small and generally there's no separation between these two. You get that? Okay. So basically as the business grows and the business wants more money, there generally is a situation where managers can't actually finance the business themselves. They generally go and obtain money from other people who are not necessarily working at the company. Okay, so basically we have this kind of gap that becomes wider. Okay, what I wanted to talk to you about, just following on from that, is which companies are generally a reporting entity. So what kind of business is generally a reporting entity? Okay. So why do we have to distinguish which companies are reporting entities and which companies aren't? Because generally reporting entities have different requirements. Okay, and the requirements are that they must provide general purpose financial statements in accordance with accounting standards, and they must be audited. Okay, so what we do is we distinguish between public companies. We distinguish between public companies, large proprietary companies, and small proprietary companies. Okay, so we are just basically labeling companies, putting them into the different boxes. And what we're going to do is we're going to actually put these two together, and those small companies will sit on their own. So public companies and large proprietary companies basically have the same requirement, and that requirement is that these guys have to provide general purpose financial statements which are in accordance with accounting standards. Okay, have to be audited. Okay, small proprietary company don't. Okay, so how are we going to distinguish what are public companies and large proprietary companies, and what are small proprietary companies? Okay, basically what we do is we look at certain criteria. So what I do here is I go 50, 25, 12 and a half, I'll explain this to you. I'm going to go 25 million and 12 and a half million. Okay? And why have I done that? I've gone 50 divided by 2, 25 divided by 2, 12 and a half. That's how I remember the numbers. 50 divided by 2, 25, 25 divided by 2, 12 and a half. Okay. Basically 50 employees. This is assets. and 25 million operating revenue. Okay, check me on that, but it's in the book. I think that's, sometimes I get mixed up between these two, but I think that's right. Okay, so basically, if you have 2 out of these 3 criteria, so greater than 2 out of these 3 criteria, you fit into this box here, the top box. Okay, so if you have 2 out of these 3, you will fit into this box here. Okay, if you have less than 2 out of 3, so you have, for example, you've got 51 employees, but you've got less than this amount and this amount, then basically you're a small proprietary company. Okay, and you don't then have to provide general purpose financial statements in accordance with accounting standards. Okay. What has happened, there has been a bit of discontentment with this way of categorizing companies. Basically what's happened is that, and I'm telling you a very simplistic way of doing it, the other thing that they look at is also your economic and political importance, okay? So if, for example, it's a company that's the only provider of bread in the country, then it has political importance. And generally, it fits into this box. Okay. So we don't only look at that criteria. Sometimes it can have political importance, and therefore goes into this box. Okay, so there are some exceptions. Basically, what's actually happened is that some companies will fit that criteria and that criteria, so they are required to follow these requirements. However, they've said, well, actually, it's wasting our time, and it's actually causing us to have to spend money which we shouldn't be spending, because as far as we're concerned, we are the management and the owners, and there is no real separation between the two. So we have grown as a business, but we've been able to finance that growth. Okay, so we're one of the exceptions. We don't actually have a big separation between management and owners. And basically, in this situation, anyone who needs information can get it. Okay.
In large.
Yeah. So all public companies will have to provide this information. But if you're a large proprietary company, you're not listed on the stock exchange. Okay. If you actually can say, well, we don't have public accountability. We don't have public accountability. What do I mean by that? There is no one who will want information about our financial statements, etc., who can't get it. Okay, they all have connection to the company. We don't actually want finance from anywhere else. We're getting it within the company from the people who actually run the company, and therefore we don't have what they call public accountability. Okay, we're running our business, we're financing our business. Everyone who needs the information can get it because they have some, clout in the business, some connection to the business. Okay, so basically, what's happened is AASB1053 has been introduced. And basically, they've introduced a tier system. Okay, they call it tier 1 and tier 2. Okay, so what they've said is, if you do fit into this box, okay, but in fact you don't actually have what they call public accountability, so you don't have anyone who's dependent on financial statements, who doesn't have connection to the business. So you don't have anyone who's basically looking to get information and can't get it. Okay, for example, they don't have any connection to the business and they can't just simply ask for the information. If you are in a situation like that, you will fall into tier 2, which means that there are reduced disclosure requirements. Okay, so basically, what generally happens in that situation? Basically, the accounting standards want to encourage efficiency. They don't want people or companies to have to provide information when it's not really necessary, because we know that it takes a lot of work to actually prepare that information, and these companies have to pay people to provide the information or draw it up. So basically what they say, if there's no real reason why you should have to do this, if there's no good reason, then you're going to fit into, if the company doesn't have public accountability, you'll basically draw up financial statements, but you'll have reduced disclosure requirements. Okay, and basically it generally means that yes, you'll probably provide income statement, balance sheet, so those basic reports, but your notes are going to be much, much less detailed. And just remember, the bulk of the work is generally the notes. You'll find that the notes are loads and loads and loads of pages. Okay, and then tier 1 obviously is if you fit into this box and you do have public accountability. In other words, there is separation between management and owners. So you've got a lot of owners, for example, or potential resource providers who can't get information because they don't work at the company and they don't have any connection to the company. Okay? If you actually look at the accounting standards, you will see that there is, on each accounting standard, it specifies what information needs to be provided if you're a tier 2 company or tier 2 business. Okay, questions?